What's up, everyone, and welcome back to Market Sense. Make sure to smash that subscribe button and hit that notification bell so you don't miss out on any future videos about making money in the markets. Now, if you're into Forex trading, or maybe you're just starting out, you know it can be a wild ride. It's easy to get caught up in the hype, seeing those potential profits, but the truth is, most Forex traders actually end up losing money. That's why in this video, we're going to dive deep into the top reasons why so many Forex traders fail, and most importantly, how you can avoid making those same mistakes. So, grab your notebook, get ready to take some notes, because we're about to break it all down. The biggest mistake I see Forex traders make is this: jumping into live trading without truly understanding what they're doing. It's like trying to build a house without knowing how to use a hammer, let alone read a blueprint. Forex is complex. There are so many factors at play: charts, indicators, economic data. You can't just wing it and expect to make money. You need a solid foundation. First, learn the basics. What are pips? How does leverage work? What are the different order types? Once you've got that down, start diving into technical analysis. Learn how to read charts, identify trends, and spot potential trading opportunities. And don't underestimate the power of risk management. This is crucial. You need to understand things like stop-loss orders, position sizing, and risk-reward ratios. The best way to gain knowledge and experience without risking real money is by using a demo account. Most brokers offer them, and they're an invaluable tool for practicing your strategies. Remember, knowledge is power. Let's talk about risk management. This is something I talk about a lot because it's so important. You could be the best trader in the world, but if you have poor risk management, you're eventually going to blow up your account. It's not about how much you can win. It's about how much you can afford to lose. One of the biggest mistakes traders make is over-leveraging. Leverage is a powerful tool, but it's a double-edged sword. If you're not careful, it can wipe out your entire account with one bad trade. Here's the thing. You never want to risk more than 1 to 2% of your trading capital on a single trade. Always, and I mean always, use stop-loss orders. A stop-loss order is an order that automatically closes your trade when the price reaches a certain level. It's your safety net, preventing you from losing more than you're comfortable with. Risk management is not about eliminating risk entirely. It's about understanding and managing it effectively. Let's be real. Trading psychology is huge. The market is going to test you. It will bring out your emotions, both good and bad. And if you let those emotions dictate your trading decisions, you're setting yourself up for failure. Two of the biggest culprits are fear and greed. Fear makes you close winning trades too early, afraid of losing your profits. Greed, on the other hand, makes you hold on to losing trades for too long, hoping for a miraculous turnaround. The best traders are the ones who can control their emotions and stick to their trading plan. They don't let fear or greed cloud their judgment. They make calculated decisions based on logic and analysis. Remember, trading is a marathon, not a sprint. It's about making consistent, disciplined decisions over the long term. Stay focused and keep your emotions in check. Chapter 4: Why you need to stop overtrading. All right, let's talk about overtrading. This is a trap that many new traders fall into. They think that the more they trade, the more money they'll make. But in reality, overtrading often leads to more losses, not profits. When you overtrade, you're essentially gambling. You're making impulsive decisions based on gut feelings rather than sound analysis. Overtrading also leads to higher transaction costs. Every time you enter or exit a trade, you're paying a commission or spread to your broker. These costs can add up quickly, especially if you're trading frequently. Instead of trying to trade every single opportunity, focus on quality over quantity. Be patient, wait for the right opportunities to present themselves, and then strike with precision. Remember, less is often more in Forex trading. Chapter 5: Why you need to adapt in Forex. The Forex market is constantly evolving. What worked yesterday might not work today. That's why it's crucial to be adaptable and adjust your trading strategy accordingly. You need to be aware of the current market conditions and adjust your approach accordingly. Are we in a trending market or a ranging market? What are the major economic events on the horizon? What's the overall sentiment in the market? During times of high volatility, it might be wise to reduce your trading frequency or even step aside altogether until the dust settles. There's no shame in sitting on the sidelines and observing the market until a clear opportunity presents itself. Remember, the key to success in Forex trading is to be adaptable, stay informed, and always be willing to adjust your strategy based on the current market environment. Chapter 6. Don't be a Forex strategy hopper. One of the biggest mistakes I see traders make is strategy hopping. They jump from one strategy to another, never giving any of them enough time to work. The problem with strategy hopping is that you never truly master any one approach. You're constantly starting from scratch, learning new rules, and trying to adapt to a new system. This can lead to confusion, frustration, and ultimately, more losses. Instead of chasing the holy grail of trading strategies, find one that resonates with you, that aligns with your risk tolerance and trading style, and stick with it. Give it time to work. Don't abandon it after a few losing trades. Remember, every trading strategy has its ups and downs. The key is to have faith in your system and trust the process. Make calculated and well thought out changes, not impulsive reactions to a few losing trades. Here's the thing, the Forex market doesn't exist in a vacuum. It's influenced by a complex web of global events, economic data, and geopolitical developments. Ignoring these factors is like trying to drive a car with your eyes closed. Interest rate decisions, inflation reports, employment data, political elections, trade agreements. These are just a few examples of the many factors that can impact currency values. For example, let's say the European Central Bank announces a surprise interest rate hike. This could send the euro soaring against other currencies. Or imagine a major trade agreement falls apart. This could create uncertainty in the market and lead to increased volatility. Staying informed about global events and economic data is crucial for making informed trading decisions. Start by following reputable financial news sources like Bloomberg, Reuters, and the Wall Street Journal. The more you know about the world around you, the better equipped you'll be to navigate the complexities of the Forex market. Let's be real for a second. One of the biggest misconceptions about Forex trading is that it's a get-rich-quick scheme. You see those ads online, those traders flashing their fancy cars and luxurious lifestyles, promising you the world if you just follow their system. But let me tell you, it's all smoke and mirrors. The truth is, Forex trading is a marathon, not a sprint. It takes time, dedication, and a lot of hard work to succeed. There are no shortcuts, no magic formulas. When you come into Forex trading with unrealistic expectations, you're setting yourself up for disappointment. Instead of focusing on making a quick buck, shift your mindset to long-term growth. Set realistic goals, track your progress, and celebrate your small victories along the way. The most successful traders approach the market with a disciplined and patient mindset. You can have the best trading strategy in the world, but if you lack discipline, you're going to struggle. Discipline is what separates the amateur traders from the pros. It's about sticking to your plan, even when it's tough, even when you're feeling emotional, even when you're tempted to deviate. Think of it like this. Imagine you're training for a marathon. You wouldn't just show up on race day without putting in the work, right? You'd follow a strict training plan, watch your diet, and get enough rest. Trading is no different. You need to have a plan, and you need to stick to it. This means setting clear entry and exit points for your trades, managing your risk effectively, and avoiding impulsive decisions. One of the best ways to develop discipline is to create a trading journal. This is where you record all of your trades, both wins and losses. Reviewing your trading journal regularly will help you identify patterns in your trading, both good and bad. The key is to learn from those mistakes and keep moving forward. Let's be real. Forex trading can be incredibly stressful. You're dealing with real money, the market is constantly moving, and there's always the potential for loss. It's no wonder that many traders experience burnout at some point in their journey. Burnout is a state of emotional, physical, and mental exhaustion caused by prolonged or excessive stress. It can manifest itself in a variety of ways, including fatigue, irritability, difficulty concentrating, and loss of motivation. If you're feeling burned out from trading, it's important to take a step back and address the issue. Ignoring it will only make things worse. One of the best ways to prevent burnout is to set boundaries. Trading should not consume your entire life. Make time for other activities you enjoy, whether it's spending time with loved ones, pursuing hobbies, or simply relaxing. It's also crucial to take breaks from trading. Remember, trading is a marathon, not a sprint. So there you have it. Those are the top reasons why most Forex traders fail. The good news is, now that you're aware of these pitfalls, you can start taking steps to avoid them. Remember, knowledge is power. If you can master these concepts, you'll be well on your way to becoming a more successful Forex trader. Patience, discipline, and a solid understanding of risk management are crucial for long-term success in the markets. If you found this video helpful, be sure to give it a thumbs up. Subscribe to the channel for more videos like this, and let me know in the comments down below what you'd like to see next. Thanks for watching, and I'll catch you in the next one.